I need to share something with you about my career, not just the famous wins that made headlines, but the painful losses that taught me everything I know about markets and life. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day. You may know that my quantum fund achieved 30% average annual returns for 3 decades, turning $12 million into over $20 billion. But what you may not know is that I've also lost billions. In 1987, I lost $300 million in the stock market crash days after telling Fortune magazine that stocks weren't too high. In 1998, I lost $2 billion in Russia's default. In 2000, I lost nearly $3 billion calling the tech bubble too early, then panicking and buying at the peak. Markets are always wrong, not sometimes, always, and I am always wrong too. The only question is, by how much? Before we continue, I encourage you to subscribe to this channel. What I'm about to share challenges everything conventional finance teaches. My greatest trades and my worst all demonstrate the same principle, reflexivity. Markets don't just reflect reality, they help create it. The participants' perceptions influence the fundamentals, which in turn influence perceptions, creating self-reinforcing feedback loops. Understanding this has made me billions. Ignoring it has cost me billions. What I want to share today are the lessons from my most famous trades, not just how I made money, but how I lost it, what I learned, and what you can apply. Because imperfect understanding is the human condition, there is no shame in being wrong, only in failing to correct our mistakes. By the end of this video, you'll understand the philosophical framework that has guided both my greatest triumphs and my most spectacular failures. Let me explain the concept of reflexivity through the actual trades that defined my career. September 16, 1992, Black Wednesday, the day I forced the Bank of England to its knees and earned the nickname that still follows me today. But let me start 6 months earlier, when I first identified the misconception that would make this trade possible. The United Kingdom had entered the European exchange rate mechanism. At an exchange rate of roughly 2.95 Deutsche Marks to the pound, far above its fundamental value, Britain needed lower interest rates for its weak economy. Germany needed higher rates to combat reunification inflation. This created an impossible situation. Britain's promise to maintain the peg was the only thing holding the pound up. Not economics, not fundamentals, just a promise. Just perception creating a temporary reality. Here's how reflexivity worked in this case. The market believed the Bank of England could defend the currency. This belief kept speculators away initially, but maintaining the peg required interest rates that were crushing the British economy, rates already at 10% when the economy needed them far lower. The worse the economy got, the more unsustainable the peg became. Yet the belief persisted. Central banks always win. Governments don't break promises. The prevailing wisdom is that markets are always right. I take the opposite position. The misconception was clear. Market participants believed government promises could override economic reality indefinitely. They confused the promise with sustainability. On September 15, Bundesbank President Helmut Schlesinger made an offhand comment to a journalist that 1 or 2 currencies in the ERM might need realignment. The market knew he meant the pound. That was my catalyst. I struck with overwhelming force. My team and I increased our short position from $1.5 billion to $10 billion, betting the entire value of my fund and then leveraging it over. Stanley Druckenmiller, my chief investment officer, had initially identified the opportunity. His contribution was recognizing the weakness. My contribution was pushing him to take a gigantic position. When I see a bubble forming, I rush in to buy, adding fuel to the fire. When I see an unsustainable peg, I rush in to break it. That is not irrational, it's understanding reflexivity. We borrowed pounds from anyone who would lend them and sold them for Deutschmarks. The Bank of England spent billions buying pounds back. They raised interest rates from 10% to 12% at 11 a.m. The market barely blinked. Then they announced 15%. Still, the selling continued. By evening, they surrendered. The pound left the ERM and fell 15% against the mark overnight, 25% against the dollar over the following weeks. My quantum fund made approximately $1.8 billion. I personally made over $1 billion in a single day. But here's what I want you to understand. This wasn't about predicting economic fundamentals in isolation. It was about understanding how an unsustainable perception would eventually collide with reality. The feedback loop reversed. Once doubt entered the market, speculators attacked. The more they attacked, the more reserves depleted. The more reserves depleted, the more doubt grew. The trend became self-reinforcing in the opposite direction. The participants' perceptions were influencing the fundamentals, which influenced perceptions. The bank spent an estimated £27 billion defending the currency. The UK Treasury later calculated their losses at £3.3 billion. But here's the paradox. Leaving the ERM actually helped Britain's economy. It allowed them to pursue independent monetary policy, lower interest rates, and recover from recession. Within years, the British economy was stronger than it had been in the ERM straitjacket. This raises a philosophical question I've wrestled with. Was I performing a service by forcing the inevitable? Or was I a predator profiting from chaos? I believe markets will always find the truth eventually. I simply accelerated the process. The real threat to open society would have been maintaining that unsustainable fiction until it collapsed in an even more catastrophic way. The Asian financial crisis began on July 2, 1997, when Thailand floated the bot after spending $33 billion, two-thirds of their foreign reserves, trying to defend an unsustainable peg. The pattern was remarkably similar to the pound. Thailand had massive current account deficits. Thai companies had borrowed heavily in dollars to invest in a real estate bubble, confident the bought dollar peg would hold forever. The misconception that currency pegs were permanent, that dollar debts were safe. The reflexive process was textbook. Capital inflows inflated asset prices. Rising prices attracted more capital. Borrowing increased to chase returns, all denominated in dollars, assuming stable exchange rates. The boom concealed growing fragility. My fund had been shorting the bot for months before the peg broke. We identified the classic unsustainable feedback loop. When the peg finally collapsed, the bot lost over 50% of its value. Dollar debts doubled in local currency terms. Companies saw currency losses wipe out all earnings. The crisis spread Indonesia, Malaysia, Philippines, South Korea. What started in Thailand became a regional catastrophe. The IMF eventually provided $20 billion to Thailand, $40 billion to Indonesia, $59 billion to South Korea. Malaysian Prime Minister Mahathir Mohamad accused me of causing the crisis, calling me a moron and worse. He claimed I was waging financial warfare against developing nations. At the IMF meetings in Hong Kong in September 1997, we had a very public confrontation. He called me a menace. I called his policies a threat too. His own people. But here's what you need to know. Mahathir was wrong about my role. By the time the crisis hit in July, my fund had already covered most short positions. We were actually buying the ringgit as it fell, trying to realize profits on our earlier speculation. Research later showed my funds broke even during the Malaysian crisis, not the enormous profits Mahathir alleged. The tragedy is that his accusations became the narrative, when the real causes were domestic policy failures, crony capitalism, and the inherent fragility of currency pegs combined with dollar-denominated debt. But I understand why he needed a villain. It's easier to blame foreign speculators than admit systemic failures. Now let me talk about real failure, my failures. Russia, 1998. This is where I learned the painful limits of my own understanding. Russia defaulted on its internal debt in August 1998. The Asian crisis had caused oil prices to collapse. Russia's economy imploded. My quantum fund lost $2 billion, our largest single loss ever. Stanley Druckenmiller admitted, "We took a risk and we were wrong. I made my fortune by understanding that markets don't reflect reality, they help create it." But even I didn't fully grasp how quickly contagion could spread from Asia to Russia, how interconnected the global system had become. There is no shame in being wrong, only in failing to correct our mistakes. We admitted the error and moved on. Quantum still returned 12% that year because we didn't cling to losing positions out of pride. The tech bubble, 1999 to 2000. My most embarrassing failure. This was my most expensive lesson in reflexivity and in emotional discipline. In early 1999, I identified the internet bubble. The Nasdaq was soaring on pure speculation. Companies with no earnings traded at astronomical valuations. Yahoo and AOL had gone up tenfold. The misconception was obvious, that fundamentals didn't matter, that this time was different. So in February 1999, I shorted $200 million of tech stocks heavily. By mid-March, that $200 million short position had lost $600 million. I was getting destroyed. Quantum was down 15% for the year. I was very proud that I'd never had a down year, and now I thought I was finished. Here's what I got wrong. I understood the bubble would burst, but I underestimated how long irrational exuberance could persist. Markets can remain irrational longer than you can remain solvent. It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong. We hired 2 young stock pickers who weren't afraid to buy radioactive tech stocks. Quant amended 1999 up 35%. I thought I had learned my lesson about fighting powerful trends, but then I did something worse. In January 2000, I walked into my office and said to Druckenmiller, "I'm selling all the tech stocks, everything. This is crazy. We're going to step aside and wait for the next opportunity." And we did. We sold out. We were sitting pretty. But those 2 young managers I'd hired, they were still trading smaller accounts, making 3 to 5% per day in tech stocks. Their accounts were up 50% for the year. Quantum was up only 7%, sitting on the sidelines. It drove me crazy. I couldn't stand it. The need to play became overwhelming. 3 times in the same week I picked up the phone. To buy back in, then put it down. Don't do it. Don't do it. Finally, I picked up the phone. I think I missed the top by an hour. Druckenmiller bought $6 billion worth of tech stocks. 6 weeks later, we had lost $3 billion. Druckenmiller resigned. I announced I was stepping back, transforming Quantum from a high-risk speculative fund to a conservative family office. The fund's assets fell from $10 billion to $4 billion. Quantum lost 21% in 2000. Soros Fund Management lost $7.6 billion total that year. Let me tell you what I learned, lessons that cost me more than my wins ever taught me. Lesson 1. Being right about direction doesn't matter if your timing is wrong. I was right about the bubble, but I shorted too early and lost. Then I was right again in January 2000 and sold out, but I couldn't maintain discipline and bought back at the peak. Lesson 2. When a reflexive process is in full swing, fighting, it prematurely can destroy you. The trend is your friend until the inflection point arrives. Lesson 3. Emotional discipline matters more than analysis. When I panicked and bought tech stocks after watching others profit, I violated my own framework. I let emotion, envy, the need to play dictate strategy instead of analysis. My conceptual framework is built on 2 propositions, fallibility and reflexivity. I forgot the first. 1. I forgot I was fallible. These weren't market failures. They were failures of timing, sizing, and emotional control. Looking across 5 decades of trading the wins and the losses, I see consistent patterns. Pattern 1, every boom-bust cycle follows a sequence. The trend, real change begins. German reunification, Asian growth, internet technology. The misconception, market belief diverges from sustainability. Pegs hold forever, fundamentals don't matter. For tech stocks, the boom, misconception and trend reinforce each other. This is reflexivity in action. Rising prices validate the misconception, attracting more capital, driving prices higher. The test, reality pushes back, reserves deplete, losses mount, valuations become absurd. The climax, conviction strengthens briefly, defenders double down. This time is different. The reversal, the trend becomes unsustainable and collapses violently. What we're seeing is a self-reinforcing feedback loop in reverse. I made money when I correctly identified we were approaching stage 6. I lost money when I called it too early, in stages 3 or 4. Timing the inflection point is everything. Pattern 2, massive conviction requires massive evidence. When I shorted £10 billion of sterling, I bet everything. This wasn't recklessness. It was conviction based on identifying an unsustainable reflexive process. The evidence had to be overwhelming. Fundamentals clearly diverging from prices. A misconception holding prices artificially. Depleting resources, maintaining the fiction. Catalysts approaching that would force reassessment. Small positions mean low conviction. Large positions mean high conviction backed by overwhelming evidence. Pattern 3, the market's perception becomes reality until it doesn't. In 1992, the Bank of England's promise kept the pound overvalued. The promise was the reality until reserves depleted and the promise became hollow. In 1997, Thailand's peg created dollar borrowing. The peg created the very debt that made the peg unsustainable. In 2000, internet stocks soared because everyone believed they would soar. The belief drove prices until reality asserted itself. This is reflexivity. Thinking and reality are interconnected through feedback loops. Perception shapes fundamentals, which shape perception. Understanding when this loop will break is the art. Pattern 4. My quantum fund record from 1972 to 30 years. My fund averaged 30% annual returns. $1,000 invested at the start became over $4 million by 2000. We generated over $32 billion in profits, making Quantum one of the most successful hedge funds in history. But this came with massive volatility. Losses of $300 million in 1987, $600 million in a single day in 1994 on Japanese yen, $2 billion in 1998 on Russia, $3 billion in 2000 on tech. The wins were bigger than the losses, but only because I admitted mistakes quickly and moved on. I made my fortune not by being right more often, but by making more when I was right and losing less when I was wrong, by cutting positions fast. Let me give you the actionable wisdom from 5 decades of trading. First, embrace your fallibility. You will be wrong often. I've lost billions being wrong. The question is, do you admit it quickly and adjust? Or do you cling to losing positions hoping they'll reverse? Imperfect understanding is the human condition. I made money by being quicker to admit mistakes than other traders. When the evidence changes, change your mind. To others, being wrong is a source of shame. To me, recognizing my mistakes is a source of pride. Second, understand reflexivity in every market. Before making any investment, ask, what is the prevailing belief driving this price? How is that belief influencing the fundamentals? Is this creating a self-reinforcing loop? What would make this loop reverse? Look at today's markets. AI stock valuations. Is there a reflexive bubble forming where belief in AI drives investment, which drives development, which validates belief? Government debt levels. What perception sustains this? Cryptocurrency. What shared belief maintains these valuations? The participants' perceptions are influencing the fundamentals. Always look for the feedback loop. Third, size positions based on conviction. When I saw the pound's unsustainability, I bet $10 billion. That wasn't gambling. It was conviction backed by overwhelming evidence of an unsustainable reflexive process. But conviction requires all four elements: clear identification of misconception, evidence the trend is unsustainable, understanding of the feedback loop, identifiable catalysts for reversal. Without all four, keep positions small. Fourth, timing matters more than being right. I was right about the tech bubble in early 1999. I lost 700 million being early. I was right again in January 2000. I lost 3 billion panicking back in. Don't fight powerful trends at full force too early. Wait for evidence the inflection point is approaching. Accelerating extremes, depleting resources, narrative cracks, catalyst events. Fifth, think systemically. My trades always considered broader implications. The pound trade. What did ERM membership mean for Britain's sovereignty and economic flexibility? The Asian crisis. How would contagion spread through interconnected economies? The tech bubble. What did irrational valuations mean for capital allocation in the real economy? Markets are embedded in social, political, economic systems. Understanding these connections gives you edge. This is a threat to open society when market failures trigger political upheaval. Sixth, know when to walk away. In 2000, after massive tech losses, I converted Quantum to a family office managing only my own money. I admitted the game had changed, that my approach needed fundamental modification. There is no shame in recognizing when conditions no longer favor your strategy. Adapt or exit. Clinging to old methods out of pride destroys. Capital. Let me return to the two ideas that defined my life and my career: fallibility and reflexivity. These concepts made me billions. They also cost me billions. But more importantly, they helped me understand the forces shaping our world, not just financial markets, but society itself. We cannot know reality perfectly. Our understanding is always imperfect, distorted by biases, limitations, incomplete information. In markets, this imperfect understanding creates opportunities for those who recognize it and catastrophic risks for those who don't. And our perceptions don't just reflect reality, they actively shape it. The feedback loop between thinking and reality drives every boom-bust cycle in history, every bubble, every crash, every financial crisis. I broke the Bank of England because I understood the pound's peg was a perception maintaining an unsustainable reality. I identified when that perception would collide with economic truth. I lost billions in Russia and tech stocks because I misjudged when unsustainable perceptions would collapse. I was right about what would happen but wrong about when, and in 2000 I was right about everything but couldn't control my own emotions. The difference between my wins and losses wasn't intelligence, it was timing, sizing, and most critically the willingness to admit mistakes immediately and without shame. My greatest trades came from understanding reflexivity. My greatest losses came from forgetting my own fallibility, from thinking I could time the market perfectly, from letting emotion override discipline. There is no shame in being wrong, only in failing to correct our mistakes. I hope these lessons from both my greatest triumphs and my most painful failures help you navigate markets and life. The prevailing wisdom is that markets are always right. I take the opposite position. Markets are always wrong. The question is, by how much? And for how long can perceptions sustain that divergence from reality? The future is uncertain. We operate with imperfect understanding in an ever-changing world, but we can improve our odds if we understand the reflexive processes we're part of, admit our fallibility honestly, and maintain the intellectual humility to change our minds when evidence demands it. That is the wisdom I've gained from 50 years of both spectacular successes and spectacular failures. Both taught me, the failures perhaps taught me more. Thank you for watching.